Do, 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 do. All right. It looks like we're live, you guys. So thank you very much for coming today. I really appreciate it. Check it out. We're gonna go through Mortgage Coach. This is a tool that Matt and I use to really break down all the finances for all of our clients. So we want our clients to know exactly the intricacies of their particular situation, right? And everyone's going to be a little bit different. So we start with, what is their overall comfort zone? We need to know, like, what are they comfortable with paying on a month-to-month basis, right? And so then we kind of help them work backwards from there. And with a combination of their down payment and really, the money that they have to work with in total. So it could be gifts coming in from someone. It could be just the cash that they have saved up. It could be money coming from their 401k. So we kind of look at their assets like holistically and try to figure out how this home is going to kind of fit into their overall investment portfolio, right? And so when we work with the assets and we take a look at how much money they have to use, and we know what their comfort level is, we come in and break down exactly where they're going to be from a price standpoint, given the interest rates of the day, right? Where they need to be shopping to be comfortable on a monthly basis. Because at the end of the day, I mean, that's the number that you're going to be stuck with paying every day, right? Every month. It's not going to be that purchase price or that interest rate. It's a combination of all of that. So we want to make sure that they're shopping in the right range. We don't want them out there going out like a lot of banks will just give a pre-approval or pre-qualification letter out there, right? And they'll be like, all right, see you later. And they don't go over any of this stuff, which is mind-boggling because then people get into escrow and they see the numbers and they're like shell-shocked. Well, that's the last thing in the world that I ever want my clients to be is shell-shocked. So we sit down, we're going to break down all these different scenarios in a very systematic manner so that they understand exactly how all this works. So this is an example of one of the mortgage coach breakdowns that we have for our clients. And what we do is we use four different loan scenarios, right? And we start with the price point going across. So you can see that here we're using from 610 to 585. The reason why we're using these numbers is because, first of all, it gets them under that $5,000 price range that they want it to be, but also it shows them really like this is the stretch. This is how far you can get to. This is the max where you're qualified at. Right, with 10% down, let's look at what happens to the payment if you come in and you wind up purchasing something a little bit less than whatever you wind up getting maximum approved for, right? Because some people get approved for, whatever, $600,000, and we'll show them the numbers, and they're like, yeah, no, I don't want to be anywhere near $5,000. Show me what 3,500 looks like, right? So it's really important to have those conversations up front, so that we understand where they're coming from and we can provide them relevant numbers. But we always want to show them what the max is that is in their qualification altogether, right? So 610 to 585, reason we chose that, there's a $25,000 break point. And when you look at the numbers, $25,000 over here is going to be about 180 bucks a month, right? So they know that if whatever they purchase or whatever they're negotiating is $25,000 different than one of these numbers, they know it's going to be 180 bucks different every month, right? So it's really simple math. When you go from 585 to 575, you're going the difference between 182 and 255, right? So you have about 70 bucks, right? For $10,000, give or take, right? $73. So I want them to know, like, if they're buying something and they're looking at, 610, but it might be 600. Well, you know that it's going to be about $70 less than this for $4,884. So it'll be closer to 4,800 bucks because a $10,000 price difference is the same as the difference between these two. Right. And then we also show them a $5,000 difference. So again, this really depends on the client. It depends on what price points we're looking at, because obviously, you start getting into the $1 million price points, you're not negotiating in $5,000 increments. You're negotiating in more, 25, $30,000 increments. So it's a little bit different that way. Um, let's see here. Let's keep going. Sorry. So once we take a look at all of the different price points, all the interest rates are going to be the same on this given day for this particular product with this amount of down payment and their credit scores and buying this type of house for this purpose, right? So you have their monthly payments are right down here, so they know what they are. Their interest rates are always clear right here. And the nice thing about this is that no matter what, while they're out there shopping, we will be able to adjust these numbers for them as they go out there and take a look at different properties. So they just email us the property or text us the property address, and we'll go on there and we'll break down that particular property for them. So they always have these numbers at their fingertips because they've got an app for that as well, which is pretty sweet. It's really nice to be able to have access to this, like right at the palm of your hand. Whenever you're out there shopping for a particular property, you can literally just pick up your phone and go, oh, sweet. Well, that's exactly what it says right here. Like, oh, perfect. Like, oh, here's the monthly payment difference. Here's the breakdown on that particular property. Awesome. So we can do that in seconds to really help somebody have it on the palm of their hand, which is not something that you get when you're working with, big banks, credit unions. They don't have access to this. They don't use this kind of technology. We do. We love it. It makes for the process to be a lot smoother, especially for clients that, really are analytical and want to know the ins and outs. So next down after your payments, we have a cash to close. And we all know in cash to close in our industry, it means your down payment and your closing costs, right? Well, why is that cash to close number so high? We can jump into and take a look at it by clicking any one of these more information buttons, more info, more info, more info. They all have little pop-ups on them with more information, right? So in here, it'll give you a payment breakdown. It'll say principal and interest is what P&I stands for, right? Your taxes, and obviously your taxes are going to be relevant to the purchase price of the home. Your homeowner's insurance should stay static going across. If you're looking for a condo versus a house in a particular price point, it should be about the same. So we don't adjust that variable. Your mortgage insurance is relative, obviously, to the purchase price of the house and how much money you're putting down. And then it will come out with a total monthly payment. So, and on top of that, this one is a condo. So we are also going to say, hey, it's about $350. Like, we don't know. They're out there shopping. We don't have the exact numbers, but we want to give them good estimates as to what it'll take. And at this point, I really want someone to understand, like, when you're looking at principal and interest payments on a house, like, I really want to make sure that you understand what that means, right? Okay, so interest, what is interest, right? That's the cost that you're paying to borrow that money, to borrow that $600,000, that $500,000, right? That's how much you're paying back that bank on a monthly basis. So on every single transaction, like, I want somebody to realize that that interest is tax deductible, right? So whereas before they might have been married, filing jointly or single, what have you, and they had no deductions, now they're able to go in there and start deducting on an itemized adjustment basis, right? So they can deduct just the interest that they paid for the entire year. They can deduct all the property taxes, right, up to $10,000 that they paid for the entire year. So that's going to help them do their tax bills. And a lot of times when I'm sitting with clients and I can see that they're relatively close to a particular tax bracket, right? I always try to go through this with them. So you have a couple that's married, filing jointly. They make combined $10,000 a month, right? $120,000 a year. You're looking at about right at that 22% tax mark. Well, you know what? If you can get under $90,000 for 2023, if you were able to get under $90,000, you would drop into the next price bracket. That's a 10% savings in tax rates. A lot of people don't realize that owning that home is going to give you a substantial difference in your taxes, right? And also when they're buying their first home, they're able to deduct any points that they pay up front. So that could really kick them, especially in that given year, and save them a tremendous amount of money in taxes. And we go over all that together. I'm not scared of calculating taxes for folks. So again, principal and interest, right? So that's the interest benefit of owning a home. But my interest rates are so high. Okay, well, you're going to get a bigger deduction this year. And then later on, when interest rates come down, you're going to lower your monthly payment and your deductions will come down. But you can take advantage of it from a financial standpoint at this point as well, right? So the other part of the P&I is principal. Well, what's principal? And a lot of people really don't think about it. But owning a home is kind of like having a forced savings account, right? Um, you make that monthly payment every month, and you really don't think about it. But part of that monthly payment goes into the piggy bank that you can tap into later on down the road, right? Right now, that piggy bank is empty, right? When you first start, and it's small accumulating. All right. So basically, you're at first, it's probably around 25% of your monthly payment will go towards your principal reduction, right? So you basically you're paying back the bank that money that you borrowed them a little slice at a time every single month. So on $3,700 on this month, you split that up in four, you're talking maybe 900 bucks, right? A month that they're squirreling away in a separate bank account called a house account, and they're going to be saving that money. So how that money grows even bigger is through appreciation, right? So that's building the equity. That's paying down your mortgage, amortization, paying that down, and the appreciation build is the price of the home growing every year, right? And what in San Diego, we're like a 5 1/8 every year on the over the past 65 years. So look at if that house is growing at 5% and you're paying that down, I mean, just in the first year alone, think about it, right? If you have that $20,000 that you're writing off in interest, right? Plus you have grown another 5% on a $600,000 home, that's $30,000. $50,000 in equity gain that year. No, excuse me. You have $50,000 that you would have had grown over that 1 year just in the money that you paid down, the tax benefit that you earned, and the appreciation that you got on that house. I would say that that's not a bad side gig for not doing anything except for making your mortgage payment, right? So this is how we like to teach our clients. We want them to understand, like, hey, you have all these advantages, financial advantages of owning a home, and this is where it all comes into play. And this is where I'm going to sit down. I'm going to teach them exactly step by step what all this means, right? So okay, great. I get the close. I get the way that it breaks down. Fantastic. Talk to me about closing costs. Well, look at the end of the day, we're not going to know as lenders what those closing costs are going to be until somebody gets into escrow, right? So we need to reach out to title. We need to reach out to the escrow company. We need to reach out. We need to find out what the notary is going to cost, what the appraisal is going to cost. All these third parties that are, part of the transaction, we have to gather up all their fees and disclose them within 3 business days by law. So up front, when I'm guesstimating here what it's going to cost, I don't know. I'm not I'm not like, I'm not a fortune teller. But at the end of the day, I can tell you I've done enough transactions in my lifetime that I can show you approximately what those numbers will look like. And so I have a detailed breakdown right in here. When you click on fee detail down at the bottom, it'll give you an estimate, right? I'm usually within $1,000 or two. I'm not going to be spot on, but I'm going to have a pretty good ballpark number. And this will give people a sense, give them an idea as to, okay, hey, this is the money that I'm going to need to come up with in order to close this transaction. So it's not just my down payment, but I'm going to also have some closing costs that come into play, right? There's a really awesome tab on here for reinvestment. So there's a lot of clients that will ask me, hey, Ed, what if I throw in like an extra $100? Or what if I make double payments, right? Or what if I make one extra payment a year? I can throw that into this little section here. Quite simply, I didn't do it on this one, but I can lickety split, and I can show you in the analysis what it would look like. Adjustment, reinvestment. So if you made an additional payment, say of what was it? It was like $3,900, right? In principal and interest a year. If you made that $3,900, how quickly would you pay that off, right? Your freedom point. So it's gonna wind up. Oh, well, that's $3,900 a month. Sorry. Here, sorry. It should be 300. There we go. That makes much more sense, right? 300. So you can see that it will show you and calculate exactly how quickly am I going to pay that monthly payment down. So, you wind up paying an extra 300 bucks a month, and that equals to one extra payment a year. You wind up saving over 5 years on your mortgage, right? So these are the type of analysis that we like to do with our clients to help them understand what the difference is, how they can save some money on their properties, and how that comes in, like how it all breaks down for them. And they have this at their fingertips all the time, right? So this is just one of them. On here, you also have monthly payment breakdowns, right? So it'll show them the interest rates and the terms and kind of how that breaks down and where those numbers are coming from in this chart, right? Your savings over the years, it'll show you how much payment you've paid down. So look at in 5 years, they paid down $30,000. So in addition to your 401k, you've also been saving $30,000 in principal reduction, right? You've also paid interest. So you've had this as your tax benefit. And it'll calculate your remaining balance. It'll show you your points. So it'll show you how much savings that you would have if you wind up going with a lower price point, right? Because in this one, we're just comparing price points, but we can do the analysis. We can compare interest rates, which we'll get to in just a second. Okay. So, and then the last one, hey, what's my net worth? Like, what's that look like in 15 years and 10 years? I'm only going to live here 9 years. So I can make those adjustments and it will show me exactly like what that property will appreciate given the number that I put in there, right, for appreciation. So this really helps and people understanding like, hey, okay, I'm not going to be there 15 years. I'm only going to be there 9 years. What does that look like if I only stay there 9 years, right? Well, now this is going to change here in a second. And it will update on their thing and it will say, all right, here's what you get for 9 years. Did I adjust the right one? I thought I did. Maybe I didn't. Nope, I didn't. Ha. Which one was I on? I was on this one. And so here it will show you what those adjustments look like in those 5 years, in those 9 years. Like, hey, how much money am I going to have saved up? Right? And here's the principal reduction that I was showing earlier. I was definitely on the wrong one. So in this particular scenario, we were trying to show somebody, hey, what are those price points going to look like if I put 15 versus 10% down, right? How much are my monthly payments going to vary if I make those changes? So we could do that analysis for them. We could help them understand like, hey, over 5 years, it's only $11,000 difference. Like over the next, monthly payment difference, you're only talking a couple $100, right? If you want to save that money for whatever projects that you might have that you're thinking about, like this is where you want to be. This is the numbers that we're going to crunch for them. Because this is not easy for someone to like come up with an Excel spreadsheet to come up with this. Like that, it doesn't work like that, right? So we have this amazing software that's going to help them really understand. Here's that reduction in monthly payment that I was showing you guys earlier with that $300 that pops in. And it shows them, they're going to save this amount of time if they're making an extra $300 payment every month, right? Over 5 years. And the breakdown is right here for them. So it's pretty awesome to really have a firm grasp on your numbers. Like the last thing that I want a client doing is going into purchasing a home and not knowing exactly what it's going to run them. So we also use this software to help people understand like what a temporary buy down would look like, for instance, right? So what's a temporary buy down? There's a 3-2-1 buy down, there's a 2-1 buy down, a 1-0 buy down. So now with the elevated rates, people are thinking, hey, the rates will come down in the near future. Like, how do I save money now? Right? How do I make my payments come down now? Like, I don't want to be paying, $4,700. Show me how to pay like $3,500. So here's how you would do it. This works if clients have some money. If clients have some additional assets that they can use, they can, instead of putting it as a down payment, they can use it to temporarily buy down their rate. And that will have much more of an impact on their monthly payment over the next 1, 2, 3 years, right? Than just paying it towards the principal. So we'll show someone, hey, if you come up with, where's our cash to close? It's literally an additional $22,000, $24,000, excuse me, $23,000, right? If you come up with an additional $23,000, like if you look at the payment breakdown, it might make a $70 difference a month, right? No, it'll be more like $180 difference a month. If you do a temporary buy down, it'll be $1,000 difference, right? On the first year. And so that will help people understand and ease into the home buying process, right? And ease into like making those monthly payments being higher and higher because not everybody's going to jump from like a $3,700 monthly rent or a $3,500 monthly rent, into a $3,500 mortgage. A lot of people will jump from like 2,000 to 4,000 and all of a sudden they're like, whoa, that's too much. That's a huge jump. So we try to make sure that um, we ease our clients into this so that they're not too scared of making that jump, right? And so why the temporary versus the permanent buy down? Well, look at there's a break even, right, that you have towards paying money towards your rate. Okay. So you pay $20,000 and you save, $500 a month. What is the break even on that? You do the calculation, divide 20,000 by 500, you get 40, right? And so you'll wind up figuring out, okay, I need 40 months to break even on that $20,000 investment. Well, I'm probably not going to hold my mortgage for 40 months. So why would I spend that $20,000 to permanently buy down the rate? Why don't I look at temporarily buying it down? And when you temporarily buy it down, whatever you don't use from the time that you refinance gets refunded to you, right? Not like a permanent buy down where you just lose the money altogether, right? Because permanent buy down, you're keeping that loan for an extended period of time beyond your break even point. On a temporary buy down, you have the benefit of having lower payments and you have the benefit of lowering your monthly payment upfront and being able to get that money back at the very end. So it's a huge benefit. It's something that works. Like I said, if people have money, if they don't, then obviously we don't have anything to work with unless we can get the seller to give them a credit, and then we can kind of intertwine that into their financing, and we can figure out how to best use that. Is it towards closing costs? Is it towards a buy down? Would they be more comfortable with the lower payment, or do they not care and they would rather the money in their pocket? So again, it really all depends on that unique conversation that we have with our clients and figuring out what's best for them. But then they can always see like, okay, so let's take a look. So the first year, your payments break down on a 3-2-1 buy down. It means your first year is 3% less than what the rate is. Okay. So if our rate is 6.5 without any buy down, on a 3-2-1, our first year is 3.5, our second year is 4.5, our third year is 5.5, and then we jump right back to that 6.5, the fourth year and beyond. And if they refinance anytime before then, like I said, they're going to get that balance back, right? So that's really important that they understand that hey, this is nice. This is a huge benefit that you can have, and you can basically have that money fixed in to do a refinance. You can roll it into the new escrow. You can pay down the mortgage when you refinance. Like there's all sorts of, you can do whatever you want with it. It's your money. It'll be refunded to you. Which is awesome. Like that's the way to go right now. And that's basically what we're doing with all of our clients. So again, we're showing them these options once they get into escrow. So we use this all the way through, right? We use this up front when our clients are looking at, different monthly payments. And they want to know what it will take a look at, what it will look like if they go from like 600 to 550, what have you, keeping their down payment the same. We look at different down payment scenarios, right? Like a 10 versus a 15 down payment, like I just showed you. And then we take a look at different buy down options. So once they get into escrow, that's when we start looking at different interest rate options, right? And so yet again, we make the adjustment on here and we say, okay, we'll take a look, right? Every single interest rate, it comes with a different cost associated to it, right? So there's always going to be a par rate. Usually, I shouldn't say always. Usually is a par rate at which there's no cost to the buyer and there's no credit to the buyer. So when you hear that like a lender is not doing any kind of lender fees, usually what they're doing is just increasing the interest rate a little bit and then fix and getting that refund back from the bank. Okay. So you've heard of buying down points, right? You've heard of paying points, buying down the rate. So basically, what they're doing is they're paying interest up front to have a lower interest rate during the term of their loan. But that doesn't always make sense. Like I just described to you, like we don't always want to buy that down permanently, right? But there are some times where you want to get it a little bit lower if the numbers make sense. Sometimes the breakdown's like 12 months. Sometimes it's even less, right? So we want to make sure that we calculate them accordingly. And so we'll take a look at it. So here is my client. He got into escrow and we were showing him different interest rates. And for some reason, the rate between, the rate between 6.625 and 6.25, there was just a huge, a very little jump, excuse me. And so on here, when we're taking a look at closing costs, it'll show us the points that they have to pay. So here's our par rate at 6.25. They didn't have to pay anything. But they weren't getting any money back. If they took slightly higher rate, they'd get $2,000 back, right? And you could see the payment difference was only $190 a month. But if they wanted a lower rate, then they would have to pay the interest up front, or they would pay it even lower to get into the fives up front, right? But when we did the calculation, the break even just wasn't there. It just didn't make sense, right? So they wound up going with the par rate, to make a long story short. But that's how we use this during the course of escrow, right? We're gonna take a look at, hey, does it make sense? And we weren't talking any kind of buy downs with them, temporary or permanent. They just really wanted to stick with the regular rate at par, but we can do that. We will do that when it makes sense for each individual client. They're like our patients, right? We're their doctors. We got to be as thorough as possible in explaining to them their financial situation, and what makes sense and what doesn't make sense. So questions, you guys? I kind of rolled through everything, I think, at this point. Matt, did I leave anything out?
No, you did a great job. Everything was covered.
Anybody in the room have any questions kind of about the software and what we could use it for? We can also, you guys, if you're going to be doing an open house, we can create this specific software for the open house so that you have it readily available. This can be printed out as a report. You can email it to someone, you can text it to someone. So a lot of the open houses that I go to, I will make sure that I knock one of these out in advance. And that way, I'm just going to ask somebody, hey, would you like to see all the numbers behind this property? I did a 20% down, 10% five, and like an FHA loan, right? And then I'll give that to them and I'll be able to text it to them. And it's just a great way of providing some sort of value at an open house instead of just giving them the tour, right? So what do you guys think?
I think it's great. I have a question about the
Yeah.
temporary buy down
Mhm.
and people who have money, about how much extra money would be good to be able to do that.
So again, it's going to depend on each individual person. So you can do a 1 year buy down, you could do a two, you could do a three, depending on how much you have. So for this particular situation, you can see that a 2 year buy down was almost $24,000, $23,500, right?
Okay.
Um, you're basically making the principal and interest payment up front for those 3 years, right? So it just depends on how much money you have set aside to work with. Um, there's no right or wrong answer. There's no like just yeah, hey, I've got 5 grand. Okay, well, $5,000 might get you a 1-0 buy down. I have $40,000 sitting on the sideline. What's the best way to utilize that to kind of ease into the higher monthly payments? I would say the 3-2-1 buy down, depending on the price point, because again, the higher the monthly payment, the more you're going to pay up front.
Right.
And so the higher that loan amount, that amount's going to be.
Yeah, the higher the loan amount, the more, the higher it's going to cost to facilitate that buy down.
Okay. Does this work with the shared appreciation loan, or is it totally separate?
Well, I can show somebody the shared appreciation loan. The one thing I can't show is the fact that they're gonna have to pay back that 20%. That's
Okay.
an overall. Yeah. So that doesn't, that's not free money, right? It's not a free like grant.
Right.
It is technically a loan. So I can show them what their payments will look like for sure.
Mhm.
That's not a problem. The hard part is like trying to explain to someone, hey, what like your net worth, like that number down there is going to be off. There's no way
Mm.
you can calculate that with the shared appreciation program.
Okay. Thank you.
Yeah. Does that make sense?
Yeah, yeah.
Okay.
Um, cool. Let's think what else. No, that's really good information. I think having the knowledge to be able to show them and show them the breakdown, I think really helps them decide. Um, so thank you for explaining that. It's very helpful.
Yeah, absolutely. And we do this with every single one of our clients. So as soon as somebody gets pre-approved with us, this is our next step. We sit down, we crunch the numbers for them, we customize it for each individual depending on the conversations that we've had during the pre-approval process. And then that way, like I said, they've got their numbers in their hands, and every one of these is different.
And yeah, sorry. Yeah, a lot of times this is where we're really getting to know your borrowers and your buyers, because this is where we're sitting down and getting to know their future, getting to know what their plans are for the next 10 years, 5 years, 15 years. How long are they going to own the homes? Do they have kids? Is the tax benefit tool going to help them as preparing for college planning and stuff like that? So getting this in front of your clients is huge, because it really gets us to get to know them and really dive into their financial futures.
All right, so I'm creeping up on 1,000 of these that have been made. Only 723 reports have been created, but they've been viewed over 3,000 times. So, we've sent out, and these are rent versus owns, 2,800 times they've been looked at, and these are total cost analysis. So, I started creating videos, and while I have you guys here, so that I can send out to the clients in an email up front, and then that way they have a little bit of an understanding before we get together. I don't want them to just have to sit down with me at first glance and see this. So I've started recording little videos, giving them an intro to the software. When I send them that link and the pre-approval letter, and I want them to understand like the ins and outs of it. I want them to understand how to navigate through it and to take a look at it. They're usually like 3 to 5 minute videos, but I'm starting to incorporate a lot more video content into my communication with my clients, because I feel like that's much more personable. It's much you don't feel like a number, right? You don't feel like, hey, this person just sent me a pre-approval and a bunch of numbers, like yay. At least this way they get to see me, they get to hear me. I give them the insights up front, and then when we get together and go over these numbers, that's when they really like I get to add the value and really dive deeper into them and explain to them, what the benefits of home ownership is, what the benefits of, all these numbers mean and how they break down. So, but at least they have a little bit of a preview. So yeah, it's really cool software called Loom. I don't know if you guys have ever seen it. I don't know if you guys have ever heard of BombBomb either. BombBomb does the same thing. It does video. You can embed these into video emails. And so I started doing introductions in my emails and just being like a quick video, like, hey, it's Eddie, how's it going? Love to be able to meet you. Please let me know when you have some time, something really quick. And nothing too complicated, but having that video and addressing someone via video is definitely more in the now than in the past, and it's been helpful in my conversions. But this it helps as well, so that they have a reference to go back to when they're looking at Mortgage Coach. If they forgot like where something is, they can go back to my video real quickly and take a look at it and say, oh, it's right there. All right, cool. That's where that closing costs were. All right, yeah, yeah.
You
Um,
on YouTube?
um, no, these videos get embedded into an email.
Oh, okay. So they're
Yeah.
individual. videos. I like,
Yeah, these are little videos that when I click on the share here, I'll show you real quick. Oops, I didn't mean to stop. Um,
I like the one you made for pre-approval that you sent to the listing agent. I think that was really good.
Thanks.
Yeah.
Yeah, I've been trying to do a lot more with video just because it's I, I think it definitely differentiates you. So I could just copy this thumbnail and
Mhm.
then come over and um create an email and I could post it right here and just put the video right in there, which is pretty cool. We just get rid of the link and center it and then write something to them. And then that way they have it right there. So it's just one different way that we do business than others. We like to make it more personable.
Cool.
Do you like Loom or the Bomb Bomb or the
I
other
like
one?
Loom. I think Loom's really easy. I mean, Bomb Bomb's easy too, but I like Loom.
Cool.
Yeah, I think Loom is a little bit different than Bomb Bomb, and where it gives you a little bit more flexibility with the way that you record. For instance, I can choose when I open up my Loom, where did it go? Oh, here it is. Oh, where'd you go? Okay. When I open up the Loom, I can just do the camera only.
Mhm.
So if I'm making a video just for one person, that's where I would go to. Um, camera issue detected. Well, yeah, I'm on camera right now, so obviously, so no camera. But it's got my microphone on there. I have a microphone up here, so it drowns out. It drowns out all the noise of my kids running around and my dog's barking in the background. And then, but it allows you to choose like what specific video screen. Like if I want to do a custom size video, I can just like highlight this video right here. So I can have a video playing and it'll kind of superimpose me onto the video. So that's kind of cool. I don't think Bomb Bomb does that. You can also have speaker notes on there, so almost like a rolling script if you want to write it out ahead of time. So it's pretty cool. I like it a lot. It's definitely getting me to be on camera more. I did buy a new camera, so it's much clearer than it used to be. Well, my wife bought it for me for Christmas. But yeah, it's I'm gonna be doing a lot more video going forward. It's just it's more personable. That's how I would like to be communicated with. And we all like the Zoom nowadays and FaceTime, so it's new, it's different, it's shiny.
Cool.
Cool, you guys. Hopefully that was helpful. Y'all a
Yeah.
little mortgage coach, a little Loom today.
Yep.
And
Very
if you guys ever need a tutorial on either one of them, if you decide to sign up for Loom, let me know. I can walk you through it. And yeah, I really appreciate you guys coming out here on Monday and coming and hanging out with me, taking a look at this new software. And if you guys ever need anything, you know how to reach Matt and I. We're always around. So thank you so much. Make an awesome week. And
cool.
hit us up if there's anything we can do to help you out.
Okay, cool.
Thanks, Ed.